Hello, this is Connie Belden, and I'm going to look at the answer to problem 10.1b as an illustration here. And of course, you can find this in the problems in your textbook or ebook as well. But we talked about notes receivable, and that was interest revenue coming to us. What about when we need to borrow money or take longer to pay the purchase of equipment or merchandise? We might choose to take out a notes payable, which means we would be charged interest expense. Also, I want to note in this chapter, we're going to talk about two types of notes payable, interest bearing and discounted. So let's go ahead and start out with regular interest bearing. Let's say that you need to take out a cash loan. You can debit cash and credit notes payable. Then when it comes time to pay it back, that is when you record the interest expense. So let's say that we pay it back 2 months later. At that time, we would debit notes payable for the amount of the note. We would debit interest expense, and we calculate interest expense the same way as interest revenue. Let's assume this is for 60 days, again divided by 360 at 8% times 225,000. So 3,000 is my amount of interest expense. And with a notes payable, cash would need to be the credit. So I credited cash for 228. Something else that might happen as well is you might need to extend an accounts payable to a notes payable. For example, if you can't pay your credit card off on time, it actually automatically turns into a notes payable because based on your contract, if you don't pay it off on time, they can charge you interest. So from the company viewpoint, we want to actually journalize. Let's say that we're unable to pay off our accounts payable, so we take out a notes payable. So what I will do then is I would debit accounts payable, take it out of accounts payable, let's assume it's 90,000, and credit notes payable. So I'm moving it out of accounts payable into notes payable. And again, we're working with regular interest-bearing notes right now, so therefore the interest expense will not be recorded until we pay the note off. So down here on the 30th, 45 days later, let's say we do pay the note off. So I would debit notes payable, again debit interest expense, and let's assume the rate was 6% for 45 days, so $675, and credit cash. Okay, you could also possibly take out a notes payable when you buy an item like store equipment and maybe pay part in cash. So this one is kind of tricky. You buy a piece of equipment for $450. Now you take out a series of 10 $20,000 notes, or is it $20,000 notes. So anyhow, the total of your notes payable is $40,000. It doesn't matter that the individual notes are $20,000 at the time you take it out. And then it also says you paid cash in at $50. So when you pay back each note, your debit notes payable for $20,000, calculate the interest expense, in this case on that $20,000 at 9% for 30 days, and credit cash. Okay. Now let's go back and talk about a non-interest bearing, or also called discounted note. That means they take the interest off the top. So the interest expense is recorded at the time the note is taken out. So you'll know if it's a discounted note because it will use the words in the problem discounted at a rate of 6%, something to that effect. So let's say that you buy equipment on a notes payable. With a regular interest bearing, if the equipment was $320, you would debit equipment for $320 and credit notes payable. But this time it said it was discounted at 6%. So what I will do is I will take the interest expense now at the time I buy the equipment. I'll calculate it the same way. $320,000, it's going to be for 180 days divided by 360 as 6%. So my interest expense will be $9,600. But then what I'll have to do is instead of debiting equipment for $320,000, I'll take away the interest expense and debit equipment for $310,400. Now, since I've already recorded the interest expense, all I have to pay back then is a note of $320. So down here on October 28th, when I pay back the note, I debit notes payable and credit cash for $320,000. I don't record the interest expense again because I recorded it up here when the note was discounted. Also, the other thing to take a look at is if you have a lawsuit that maybe you lost or might probably lose, you usually go ahead and record it. So in this case, let's assume that we lost a lawsuit, so we're debit litigation loss, but we're not going to pay it till next month. So instead of crediting cash, I will credit litigation claims payable. Also, if you offer an extended warranty with your product, you're going to want to estimate what that warranty expense is going to be for the year by debiting product warranty expense and crediting product warranty payable. And then the last thing we're going to take a look at, remember back here on November 16th, we took out $20,000 notes, 20 of them at $20,000 each. So remember, we have a notes payable $400,000. However, we paid one of those notes. So we have 19 notes left at $20,000. The interest rate is 9%. Now we want to record the amount of accrued interest that has been earned from the time we bought them on November 16th to the end of the year. So that is 45 days. So for November 16th to December 31st is 45 days. We have 19 notes left, $20,000 each at 9%. So therefore, our interest expense that's incurred is $42.75. Now I haven't actually paid it yet, so I'll credit interest payable, but we want to record the interest expense when it occurs. So you need to take a look at when it was bought to see how many days are left. Okay, so that was a little bit of a tricky part to it. Okay, I hope this helped you out with notes payable. Thank you.